Good morning. I hope you're all very well. February marks the end of the tax year. So I'm going to have a quick ecos and market update today, and then I'm going to hand over to my colleague, Marius, who will take you through some tax tips and bust some myths on tax-free savings accounts. All very, very interesting. But I'm truly hoping that everyone's feeling good after a great market performance in January. Certainly makes life a little bit more comfortable. And it was quite an amazing January. Look at those huge returns. Some of the biggest reversals from the losers in 2022. You can see that the FANG Plus Fund up 22%, but China as well, also very strong return, 15%. Fourth Industrial Revolution up 14%, Europe up 14%. Some very, very, very nice returns. The laggard for the month being healthcare, still positive, but only barely. And as it was one of the biggest winners in 2022, it's not surprising that there was some catch up on a relative basis compared to other asset classes. But I think a nice time to top up on some healthcare, given its great long-term outlook. We had a similar performance pushing through into the funds. You can see there on 1 month, FANG fund being number one, up nearly 20%. China number two, fourth IR in the third position, Europe in the fourth, and emerging markets in the fifth position. But over the longer term, over 12 months, it's still very much a defensive story. It's still very much healthcare. As you can see, the number one and number five being healthcare, and value as proxied by Berkshire Hathaway in number four position, and returns looking far more modest at low double digits for the 1 year period. So fantastic January, but still some catching up to do. So in January, we had the World Economic Forum meet at Davos, and they caught on to our cautious optimism and started talking about upgrades and not downgrades. Now, things aren't great. I'm certainly not saying that, but what is nice to see is that things have stopped getting worse. Now, that's it's a bit of a silver lining. I suppose it's like grasping at straws, but it's better things have stopped getting worse. I wish we could say the same for South Africa, but I'll talk more about that when we get to SA slide. But at least globally, things have stopped getting worse. So we saw the IMF raise its global growth forecasts for 2023 from 2.7% to 2.9%. Still pretty poor, below trend growth, but at least it's being upgraded and not downgraded. And a similar story is shown in this chart, which shows the leading economic indicator in black, which you can see they're still forecasting recession. But the dotted blue line is the diffusion index, which just shows the number of countries that are seeing an upgrade in their performance versus those that are seeing a downgrade. We're seeing more countries being upgraded than those being downgraded. Particularly on the upgrade side, we've got China, Mexico, and Brazil all improving, whereas the US continues to be the one that is disappointing and leading the downgrades. So generally a more optimistic outlook in January, and I think that's obviously what drove the markets, and higher markets have also, in a bit of a spiral, also lead to more optimism. So that is good for the year ahead. Another thing that came out at Davos, which was quite interesting, was talk about AI and talk about ChatGPT. And I'm sure you've all heard about ChatGPT and have asked it to answer some interesting questions. We asked it, what was the best investment strategy? And it gave a beautiful, long-winded, multiple length paragraph, which was fantastic to read. But the bottom line is it said, it depends, and speak to your financial advisor. So the good news for now is that my job is safe, and the robots aren't going to take over just yet when it comes to financial advice and telling you what the best investment strategy is going forward. So we will continue to try and do that in these webinars, and we'll get onto that now. So back to the US. For once, I'm not talking about Powell because you heard all about Powell 2 weeks ago. So try to keep it a bit different this month. And it's more on the entertaining side, and American politics never ceases to entertain. And here we've got Kevin McCarthy, who was elected 55th Speaker of the US House of Representatives, succeeding Nancy Pelosi, and ending the Democrats' hold on both chambers of Congress. But it's certainly come at a cost. Marjorie Taylor Greene of the Freedom Caucus backed him through a right-wing rebellion and 15 rounds of voting. And the Freedom Caucus now has quite a strong influence on the Republican Party. Now, Greene is a rather interesting person herself. She supports QAnon, She has spoken at white supremacist rallies. She suggests that Jewish-controlled space solar generators were responsible for the wildfires that happened in the US. And she's even gone as far to say that if she was managing the Trump supporters who attacked Congress, they would have been armed and they would have won. So yeah, US Congress just got a whole lot more gridlocked. So why does this this entertainment impact performance and investments? Well, because it does increase the risk that we have lockdowns, a showdown about the debt ceiling and possibly a US shutdown. Now, the chart on the right shows how the US debt has risen regardless of the administration. And politicians have raised the debt ceiling 78 times since 1960. So raising the debt ceiling is certainly not an issue, and it's not something that's new. But in 2011, we did have a deadlock. And that time, it caused S&P to downgrade the US's credit rating, which caused S&P to fall 16% and gold to rally 20%. So while we're not positioned for this, and while we think it is a low probability event, it certainly does have a big impact if it happens. And why do we think it's more likely than usual to happen? Well, because the Freedom Caucus does have a bigger say, and they certainly are going to fight hard for some spending cuts to negotiate a raise of the debt ceiling. So we'll be watching that quite closely. Of course, the Fed could always print their $1 trillion platinum coin and avoid all the issues, but there are probably simpler ways of getting around it than that. In terms of other tail risks in the US, well, the US Justice Department has sued Google, calling for a breakup of its ad technology business, a heated antitrust fight. And this is the first time that the US Justice Department has mandated something like this since the breakup of AT&T and Bell Telecom in 1982. So quite a major mandate, quite a major impact, and could have quite a major impact on Google itself and the other huge giant platform companies. Now, we saw China lead this antitrust fight about 2 years ago, and we've been talking about it in the US for longer than that, and it does take longer for the US to get around to doing things, but this time it could be different, and it could have some big implications for Google. So we'll be watching that as well. When it comes to the US economy, though, nothing too much different. We've still got a very tight labor market, while at the same time we've got growth slowing down. So it's that dichotomy that is causing people some concern. The economy seems to be moving into a shallow recession, but because of this very strong labor market, the Fed continues to hike rates, and the Fed hiked 25 basis points, taking the top of the target range to 4.75%. But at the same time, we are seeing some slowdown in the labor market. We've got the tech sector continuing the layoffs, with Amazon announcing 18,000 people to be laid off, Google 12,000, Salesforce 8,000, and Dell almost 7,000 people. So we might start to see some slowdown, or at least loosening in the US labor market soon, when these layoffs take impact. But for now, we remain underweight the US. We do think that the dollar will continue to weaken, and that margins for these large cap tech shares are going to be under pressure. And as a result, we stay underweight the US. Then also something we have spoken about in the past, but just an update for those of you who are trying to avoid the ESCOM debacle and trying to find somewhere safe to invest your money offshore and possibly looking at buying property offshore. Well, I think it's wise just to look at this chart on the right from Bank Credit Analysts, which highlight which countries face some property headwinds and which are less likely to see falls in their housing market. So New Zealand is top of the pops in terms of the most dangerous housing market, and the one that they say you should avoid the most. It had its biggest pullback in December, a 5% drop, biggest pullback since 2008. Canadian house prices have fallen 13% from their peak in 2022. Swedish house prices have fallen 15% from their peak. And Bank Credit Analysts believe that there's a lot more of this to come, because most of the property purchases that happened in the last 2 years at almost zero interest rates happened on variable floating rate debt. And as interest rates start to rise and continue to rise, that's going to have a huge impact on the mortgage payments, lead to falling house prices, lead to distressed individuals, and lead to a slowdown in the economy. So for now, they suggest avoiding New Zealand, Denmark, Norway, Finland, Sweden, and Australia. Those are the countries which will face the biggest risk of further housing market price declines, and which will weigh on the economies through negative wealth effect and a slowdown in spending and growth. So just something to keep on the radar. What's quite interesting to see on the very bottom left, which is where the housing market is looking strongest, and there you have the US, which is still looking good. And it's one of the reasons that we believe the US is going to have a shallow recession this year, because their housing market is simply not looking as frothy as the rest of the world. Germany, France, Belgium, Ireland, Spain, Italy also not looking not as bad as other countries. Then talking about emerging markets, just focusing on the semiconductor space and electric vehicle batteries, EV batteries. Now, Intel CEO said that semiconductors are the strategic asset of the next 5 decades, potentially more important than oil was over the last 5 decades. Quite a big claim, but certainly semiconductors go into almost everything these days, and particularly very important in the renewable space. So while you look at renewables, emerging markets are important as the biggest producer of EVs and semiconductors. So China produces 56% of the world's EV batteries, with Korea producing 26% and Japan 10%. That's a huge dominant market share. At the same time, when you look, that's EVs. When you're looking at semiconductors, that's shown in the charts on the right. You can see that for the high-end semiconductors, Korea and Taiwan produce all of the high-end semiconductors, with Taiwan having 2/3 market share and Korea 1/3 market share. And then on the very left-hand side of the chart, you can see the low end, or the bigger semiconductors, with China having the predominant market share. So overall, emerging markets also dominant in the EV space, EV battery space, and the semiconductor space. Whereas when it comes to semis, the US makes up only 12.6%. So yes, the US is doing a lot of saber rattling right now and trying to get all their partner countries, Netherlands and Japan, and Taiwan and Korea to not sell to China. But a lot of those details are still not available for public. So while there has been a possible or potential or alleged deal, no one is giving out any details about when it's going to start or what exactly that means. So we'll see how that rolls out. Right now, yes, there is an excess supply of the low-end semiconductors, and that's led to a fall in prices and certainly a fall in some of the emerging market semi shares. But there's some positive news coming out of Taiwan, where the new export orders within the manufacturing PIs off their September lows, and similarly South Korean new export orders have also rebounded very strongly. So we're starting to see some green shoots in the semi space, and that demand-supply imbalance is likely to clear in the second half of this year and lead to some strong demand and some good profits feeding through into the emerging market space. Meanwhile, China, the bedrock of all EM plays, continues to grow strongly and to rebound as the economy opens up after the 3-year COVID lockdown. And yes, I mean, you saw the stock market has recovered very, very rapidly over the last 3 months, and obviously ahead of the underlying economic growth. But we do think there's a lot more to come from China as the economy opens up, at least over the next year. Longer term, there are definitely some strategic geopolitical risks, but I think right now China is benefiting from its reopening. So here we have our president talking about the fact that there might need to be a national state of disaster about as a result of Eskom and load shedding. And certainly Eskom has been a disaster for the South African economy. The month of January has been very strong for commodities. Copper has had a very strong start to the year, as well as other industrial metals. And it's normally very good for the Rand, January. So the Rand normally has a very good January, and partly driven by commodities. But this January, the Rand has not benefited. The Rand has not followed the copper price or the iron ore price. And that's because you have to mine those metals and you have to export them. Kumba Iron Ore released their Q4 sales, which fell 35%, and they blamed the biggest reason for the fall in their sales on Transnet and the fact that they can't get their iron ore exported. So we've mentioned that before, but it's definitely going to be an issue for our terms of trade. If you can't mine because of load shedding, if you can't export because of Transnet, well then we're not getting in any foreign revenue, which is very important for our country. Load shedding continues with no clear plan. I think that is the biggest concern, is that we're now 4 months into continual stage 4, 5, or 6 load shedding with a lot of promises, but no detailed plans about how things are going to be fixed. We do have the State of the Nation address this week, and hopefully we'll get some answers from that. But at the moment, there's no plan whatsoever, and it is having a huge impact on our economy. All sorts of numbers are being put out in terms of the impact. Shoprite spent 600 million rand on diesel over the last 6 months. That certainly is a big concern for their profit margins, and I'm sure they're pushing on some of that cost onto the consumers. So it's a concern for the cost of food rising, which is not good for any consumers. And once again, we're seeing the car powership deal back on the table, which is very, very confusing. It's the only detail that's come through about the plan. Even though there's no plan, car powership is back on the table. The only thing that's being mentioned, and it doesn't make any sense. ARTA, the organization undoing tax abuse, estimates that the cost of car powership would be around 5 Rand a kilowatt. 5 Rand, that's double to triple the cost of renewables. More importantly, it's more expensive than the cost of running the emergency open cycle gas turbines. So right now we're sitting with our open cycle gas turbines, which aren't being run because we don't have diesel. So we've got plants that are in position, can be turned on immediately at a lower cost than car powership. And we're choosing not to use that, but we're talking about car powership, which will take a year to turn on, and at a much higher expense. So that's, it's one of the confusing things that hopefully is cleared up in the plan. The other thing that is confusing is why TFSA is charging Eskom more than the other refineries in South Africa, 3 Rand more, looks like, for their diesel. And why Eskom is still paying the road accident fund and paying the fuel levy. Now, if you strip out the high costs that TFSA is charging, if you strip out the road accident fund and you strip out the fuel levy, then all of a sudden running those open cycle gas turbines becomes a lot more realistic. And again, why aren't various parts of the government talking to each other? Yes, we need a plan about renewables and fixing Eskom, but we also need a plan about just getting various parts of the government to talk to each other. It is very, very, very concerning that not only are there no reforms, but there are no plans yet. So we wait to see what happens, and we all hope for the best. But running through a checklist of what was promised at CERN last year, State of the Nation address last year, and what has been achieved, certainly in the energy space and in the visa space, there's been very, very little progress. So I'm sure we'll hopefully see some great promises at the State of the Nation address, but whether they are implemented, we'll have to wait and see. Meanwhile, there's still a concern that there might be another potential national state of disaster. I mean, also what happened with the COVID national disaster in terms of corruption. So there are more concerns around that. We had the grey listing, which we might hear an update towards the end of February, and whether that South Africa is going to be grey listed. And we have the budget at the end of February. So a lot of event risks are happening. So that's the bad news about South Africa, why we are underweight South African equities. The good news, and why we are overweight South African bonds, is that because load shedding has been so terrible, such a disaster, and led to so much demand destruction, so much job destruction, so many people immigrating, that demand in South Africa is very, very low. And without demand, you have no inflation. There's no demand over inflation. And so the chart on the right shows that core inflation relative to pre-COVID trend is negative in South Africa. You can see the ZAF, the third from the right. Only Japan and China, which have huge issues from shrinking population growth, have lower inflation than South Africa does. So that's good for bonds. And core inflation fell to 4.9% in December, and the SARB raised rates by 0.25% to 7.25%, which is creating high yields across the bond curve. So now whether you're in money market credit or bonds, you're getting a pretty decent yield, which is not impacted by growth. And so at least there are some safer regions to invest in South Africa. Now, South African bonds are certainly not without their risks. I've mentioned a number of event risks, which could lead to further rand weakness, and that will lead to bonds weakening as well. But overall, we think that a lot of the risks are priced in, and there's at least a decent margin of safety in South African bonds due to their very, very high yields. So we remain overweight South African bonds. Our positioning doesn't change. Just two interesting charts that I would like to share with you. The top right-hand chart talks to the old adage, when America sneezes, the rest of the world catches a cold. And that was certainly very true. So if you look at the left-hand bar graphs, that shows the correlation of the emerging markets to developed markets in the 2000s, 2001 to 2008, showing over a 70% correlation. So when the US slowed down, EMs was also slowed down, and probably slowed down more because they were so geared to the US and developed markets. But in the last decade, that has changed radically. And now if you look at the two bar charts on the right, the light blue shows the correlation of the emerging markets in China, which is about 50%, whereas the EM and DM is down to below 20%. So yes, still some impact from DM and the US, but by far greater impact to emerging markets from China. So as we are expecting a US slowdown this year, with interest rates continuing to be raised in the US, and a potential mild recession in the US, well, that means that there isn't going to be as big an impact on emerging markets than we have seen in previous decades, which supports us being overweight emerging markets and China. And that's also partly driven by our weaker dollar outlook and why we stay overweight the global assets, and we do have protection against a stronger rand. Now, that's further influenced by the bottom right-hand chart, which is really quite incredible. It's from the IMF, and it shows contribution to world growth in 2023 and 2024. So it's not actual growth, but it's the contribution to the growth. So how much of new growth is coming from various entities. And the light blue regions are developed markets, and the orange, beige, red colors are all emerging markets. You can see there, almost the entire contribution to growth over the next 2 years is driven by emerging markets. China being the biggest contributor to growth in the red, India the second biggest contributor to growth in the pink, and then the beige color is the rest of EM excluding China and India. And then the bottom two blue lines, the dark blue is US, the lighter blue is Europe, and then in the middle there, the rest of developed markets, which is mostly Japan, Australia, Canada, showing very, very small contribution to growth from developed markets. So while developed markets make up most of the assets in the world and certainly influence markets and economies, the growth and sensitivity to developed markets is all about emerging markets going forward. So the emerging markets continue to play an important role in our portfolios and an important role in the global economy. So that's our EM view, and then we still maintain the fact that we think that inflation is going to be higher for longer, which means that interest rates are going to be higher for longer, and volatility is going to stay higher for longer, which all overall means we need to stay overweight to US value, and let's say overweight global healthcare. And in the short term, thanks to the very, very phenomenal returns we had in January, we have put protection in place on some of our assets in case there is a pullback in the near term. Because we maintain our overall view, which is that growth is going to be low, much lower than it was for the 80s, the 90s, and the noughties. And volatility is going to stay high. In a low return, low growth environment, you need to be nimble, you need to be tactical, and you need to look very hard for areas that are going to grow in the world, and hence our themes. Now, before I hand over to Marius, who's going to bust some myths and give you some tax tips, I just want to take you through this table, which I take you through every year in the month of February. So these are the limits that are in place until the end of this month. We'll only be told at the budget this month what the 2023-2024 limits are. Hopefully they go up, But so these are the limits that are in place now, and what you need to maximize and utilize before the end of February where you can. So just talking through the horizontal rows. So product, that is what you want to invest in. So you want to invest in a unit trust, any unit trust, you want to invest in ETF, any South African ETF or any South African share. That's the product, but you can do so in a variety of ways. And that talks to the 6 horizontal lines. You can either just go direct, you can open up a stockbroking account, or you can to buy shares, or you can invest directly into a unit trust with a platform or an asset manager. And then you don't have any tax benefits. You also don't have any liquidity constraints. You do have some annual exemptions, 23,800 Rand interest exemption and 40,000 Rand capital gains tax exemption. But generally, these assets are only seen as capital gains if you hold the shares for longer than 3 years. But that's sort of a tax liquidity inference, and it's not guaranteed. It's just there as a benchmark. So generally, this is for your highest tax option, but your highest liquidity option. Then you've got the second line is your tax-free savings account. Now that's a wonderful account. Morris will go into all the details, but you're allowed up to 36,000 Rand a year contribution with a lifetime limit to 500,000 Rand. No global limit, same as going direct. You can put 100% offshore. You don't pay any tax on the growth, and there's no lock-in. You can pull the money at any point, but if you do, you can't put the money back in. Then the third line is quite interesting, and I put out an article a few days ago or over the weekend talking about this. And this is the new 2-pot system, which hopefully will take place, will start in March next year. And it opens up a whole new savings vehicle. Basically, it divides your RA, your retirement savings, your pension fund into 2 pots. 2/3 is retirement savings, which is similar to your current savings, and 1/3 is a savings allocation, which is almost like a TFSA, in that you can access that pot once a year, and there's 0% tax on that growth. So it becomes very useful if you've maxed out your TFSA and you haven't maxed out your retirement savings. That the benefits there, you've got 350,000 Rand a year, or 27.5% of your income, whatever is the lowest number of that. If you haven't used it, you can start allocating more to that, and you can then have access to that in a shorter time horizon. So some good tax benefits with some decent liquidity. And obviously, if you don't need it, you can then either move it to a different pot or roll it over to next year, and it's available in case that you do need it. So a great new product, and hopefully it starts next year in March. And then the bottom two talk to your life products and endowments, your living annuity. There is a global limit that's dependent on the platform. You do have lower tax rates than your marginal tax rate in an endowment. Living annuity, there's no tax, but there are the most extreme lock-ins. Your endowment is locked in for 5 years, and your living annuity is only for post-retirement. So those do come with their own liquidity issues. So generally, as you move down the table, you get less liquidity, but you get more tax benefits, and that's what it's all about. The SARS basically wants to encourage people to save, and so they say that the longer you allocate that money to your savings, the more you can convince SARS it is savings, not short term, then the more likely they are to reduce the tax on those products. But yeah, that's the overall high-level view of your various products. And I'll hand over now to Morris, who'll take you through the TFSA in particular, and the retirement annuity and retirement savings, but just the current version now. It's not going to talk about 2 pots. Okay, thank you, Marius.
Hello, everybody, and welcome to Tax Busters, where we'll spend a bit of time today busting myths around the tax-free savings account and discover how it is an ideal investment for pretty much anyone who doesn't have one already. Now, the tax-free savings account itself is among the best examples of economic dirigism that one can possibly show, where government has created attractive incentives to incentivize household savings toward tax-efficient investing. The tax-free savings account itself as legal structure became law in 2015, and on SARS's website, under what it is, it's the first link on there. It literally says it's there to encourage households to save. I'll make sure that link is in the description when we post this video for anybody looking for more information from the source. But the bottom line of it is that the tax-free savings account is a legal vehicle. It's designed to encourage savings. And at the end of the day, to you, it's a tool that you can put up to 36,000 Rand per year, subject to a 500,000 Rand lifetime limit into, and watch that money grow tax-free. Now, tax-free means properly tax-free, free from income tax, free from dividend withholding tax, and free from capital gains tax. And that means that you can harness the full benefits of compounding the way investments should be enjoyed. All that being said, let's bust some myths around the tax-free savings account. The first one is that there's only one kind of tax-free savings account. Now, this is not true. A tax-free savings account, as we've said, is a legal structure. It's like a basket. And in that legal structure, you can hold a wide variety of investment products, from fixed deposits to ETFs, for example. So the core essence here, the core concept here, is that the tax-free savings account is the basket. We call it a wrapper. And in that basket, you can hold various investment products. The second myth is that you can have only one tax-free savings account. Now, this is not true. You can have as many tax-free savings accounts with as many providers as you like. The limits are in terms of the legal structure, and those limits are 36,000 Rand annual contribution, 500,000 Rand lifetime contribution, and anything above and beyond that is going to be taxed at 40%. So don't over-contribute. The third myth is that tax-free savings accounts are for local investments only. Now, among all these myths, it's probably the most misleading because you can actually go 100% offshore in a tax-free savings account if you like. So your tax-free savings account is a South African savings account, but in that you can have, for example, a SIG 500, which is our ETF that tracks the performance of the 500 biggest companies in the US by tracking the S&P 500 index. Myth number 4 is that you can't withdraw from a tax-free savings account until retirement. Now, this is not true. You can withdraw as and when you like, but it doesn't mean that you should. Any withdrawal is going to still count against your 500,000 Rand lifetime contribution, and you can't withdraw and reinvest. It's still taken away. It doesn't replenish your contribution. The real thing here is going to be to target growth, and putting the money in there as soon as possible and leaving it in there as long as possible is going to target that strategy most effectively. Myth number 5 is that you need regular income to open a tax-free savings account, and this is also not true. Minimum contributions are set by your provider. In Sygnia's case, our minimum is a 500 Rand monthly debit order, and your next question links us to myth number 6, is that you must contribute every month. So what happens if you can't contribute? Well, with Sygnia, you can stop contributing at any time with no penalty. So no, in terms of myth 5, you don't need regular income for a tax-free savings account, and no, in terms of myth 6, you can stop contributing at any time with no penalty. Myth number 7 is that you must contribute a minimum every year. This is not true. It's ideal, but not compulsory to make use of your 36,000 Rand yearly maximum contribution. Myth number 8 is that you can only get a tax-free savings account at 18 years or older. This is not true. From newborns to pensioners can have a tax-free savings account at any time of their lives. Under 18s will need a parent or a guardian, but seeing as this account is really ideal for the youngsters, that shouldn't stop anybody. Second to last myth, myth number 9, is that the tax-free savings account is the same thing as a retirement annuity. This is not true. Both tax-free savings accounts and retirement annuities carry zero tax on growth in the case of capital gains tax, dividend withholding tax, and interest tax, but that is really where the similarities end. They are in reality totally different savings structures. For example, in a tax-free savings account, you get an income, you pay income tax on the income, and then you contribute that net amount to a tax-free savings account, where, for example, with a retirement annuity, you deduct your contributions from your taxable income. So it's totally a different kind of thing, and we'll focus on retirement annuity shortly. With that, I'll introduce myth number 10, which is that an RA replaces a tax-free savings account. Now, this is also not true, because a tax-free savings account actually has some unique benefits that a retirement annuity does not. For example, you can withdraw from a tax-free savings account whenever you like, where you can't do that with a retirement annuity. A tax-free savings account withdrawals are going to be 100% tax-free, where that's not the case with a retirement annuity. And a tax-free savings account has no offshore limits, where a retirement annuity does. So by busting the 10 myths, we've seen that the tax-free savings account is versatile and that it's simple, but I can almost hear you asking me, what's the opportunity statement? We get it, it's versatile, it's simple, but why do it in the first place? Well, some in-house research by one of our portfolio managers, Mr. Wessel Brandt, addresses this question very thoroughly. Wessel compared the tax-free savings account investor, investor A, to the long-term investor, investor B, and the short-term investor, investor C. And the findings show that the tax-free savings account investor outperforms the long-term investor by 23% over a 30-year time frame, and the short-term investor by 42% over a 30-year time frame. So the implications of the findings are that you can actually outperform the best stock picker on the market just by making use of your tax-free savings account facility, which is your birthright as South African citizen. And that opportunity statement makes the account particularly ideal for beginners because it caters to small amounts, and it's essentially something like investments on easy mode. Imagine how rewarding the journey can be of opening a tax-free savings account, contributing early and getting into that situation where tax-free compound growth in the long term compounds on other tax-free compound growth in the long term. And it can be an extremely rewarding journey and an extremely rewarding introduction to the world of investments for a beginner investor. It's also ideal for the seasoned investor who just hasn't made use of it yet. I've seen experts ignore the tax-free savings account at their own peril. And then thirdly, it's super duper ideal for the stargazer. The stargazer is a Sygnia in-house concept. Broadly speaking, it's the idea that if you make the prudent decision to invest on behalf of your youngster, particularly from a very early age, you turn them from an ordinary saver or a non-saver into a stargazer, which is a particularly extraordinary type of investor. And don't be fooled, the combination of an early start and the long-term compounding effects, tax-free compounding effects, can actually turn a very humble tax-free savings account into a fund that really makes dreams come true over time. But if what I'm saying makes sense and you choose a tax-free savings account provider, remember the following important factors. Look at fees. Ideally, a tax-free savings account should be a low-fee solution. It doesn't help you have all this tax-free benefits, but it's getting eaten up by fees. And fees come in layers. Usually it's something like there's a total investment charge, there's a wrapper fee, which is the cost of essentially communicating to the regulator that this savings account of yours is a tax-free savings account and you must enjoy the tax-free benefits of it. That's called the wrapper fee, wrapping the investment inside the tax-free savings account structure. Then there's also an administration fee, which is quite self-explanatory, and an advice fee. If you make use of an advisor in this process, you're going to pay that advisor a fee as well. Also consider performance. The structure of a tax-free savings account is ideal for long-term investment. So look at 3 to 5 year numbers at least when considering performance of the products that you'll be putting into the tax-free savings account. Also look at the track record of your provider. Does your provider have a clean track record in terms of compliance issues? A red flag here would be a string of poor audits, for example. Also consider the offshore exposure benefit. This is a major benefit that the tax-free savings account offers. Make sure you can get offshore exposure through your provider if that's something that's important to you. Also consider maximizing the particular tax-free elements of the account. Remember that interest is tax exempt, or fixed interest is tax exempt up to 23,800 Rand per year anyway. Also, similarly, capital gains are tax exempt up to 40,000 Rand per year anyway. So considering those two factors alone and ignoring risk appetite for the moment, considering those factors, tilting your asset mix inside your tax-free savings account to the more aggressive side may make the tax-free particular elements of the account work better for you. Remember also that a tax-free savings account is often the start of your relationship with the provider. And the next thing that you do after you open the account and contribute is you're going to wonder, how's my account doing? So it's very important to look for regular, accurate, and accessible reporting. Our solution for this is a program that we offer you called Alchemy. It's on your bottom right-hand screen at the moment. And there you can monitor your portfolio and find exactly that, regular, accurate, and accessible reporting. Last but very much not least, consider the rules. You want full transparency in terms of important issues like your minimum contributions and your payment methods. The second tax-efficient investment vehicle that's super relevant to investors today is the retirement annuity. The retirement annuity is governed by the Pension Fund Act, and it's there for anyone who wants to save for retirement tax efficiently. The main difference between the provident fund and a retirement annuity is that the provident fund is linked to your employer, but a retirement annuity is directly linked to you. This gives you freedom, this gives you mobility, and it gives you flexibility. And I've often heard the retirement annuity likened to the cell phone of savings, where the provident fund solution would be more or less the landline. The two-part system that Carl spoke about is also going to make retirement annuities more attractive and exciting, as a third of your savings will be available to draw on at any time. Now, there are ample sources online to research retirement annuities through, but the main gist of it is, once again, that it's also just a legal structure. It's also a wrapper. It also directs individuals toward tax-efficient investing, and you can deduct your contributions up to 27.5% of your taxable income, up to a maximum of 350,000 Rand per year from your taxable income. And then also watch it grow tax-free, free of dividend and interest tax, free from capital gains tax. And that also means that in the retirement annuity, you can benefit from compound growth over time. Some withdrawals are going to be taxed later on. We'll get to that just now, but also bear in mind that retirement annuities are regulated by Regulation 28, which will limit your offshore exposure, for example, to 45%. Luckily, our risk models still show that that is plenty. So the benefits of an RA are, firstly, that you own the investment. So no exit is going to be necessary from your investment if you change employers. Also, you choose the service provider. You get to choose them based on fees, anything that you find important, their investment style, their performance over time, their transparency, even the extent to which they have independent oversight. Anything that you find important, you choose the service provider. Thirdly, you have full control over your investment strategy to sculpt your portfolio within Regulation 28 limits. And on Alchemy, we give you the facility to switch between 800 funds on Alchemy at any time at no cost. And that gives you the ability to build and sculpt your own Reg 28 portfolio. You also get to choose contributions subject to limits by your service provider. With Sygnia, contributions can be adjusted to your changing needs at any time and at no cost. With us, you can do lump sums, you can do debit orders, you can do a combination, and you can adjust those contributions at any time with no penalty. The fifth benefit is that you do actually pay less tax overall in a retirement annuity. For example, at age 55, you have saved up this pile of cash, then you'll get an opportunity to withdraw from your RA in a lump sum, so once off. The first 500,000 Rand withdrawal from that retirement annuity pile of cash, as I call it, is going to be tax-free. Then anything above 500,000 Rand is going to be taxed at a lower than marginal rate. And then typically what you'll do with the rest of the pile of cash is annuitize that, which means you take it from a pile of cash to a stream of cash that's going to pay out as you enjoy retirement. And that is going to be seen as income by SARS and taxed as such. The sixth benefit is more of a regulatory miracle than a provider perk, but that is that your creditors have no claims against your retirement annuity. So once you contribute your money to your retirement annuity, it's there to help you when you are old, to take care of you when you are old, and creditors cannot use a retirement annuity to settle claims that they have against you. Finally, and this is more of a provider perk with Sygnia, we charge 0 fees on our retirement annuity wrappers. So this is that cost of communicating with the regulator that this account of yours is to be seen as an RA and you must enjoy the benefits of an RA with this account. We do that work for free. That's what we mean by 0 fees on RA wrappers. So how does it all work? Well, if what I've said today makes sense to you, the right thing to do is mail admin@sfs.sygnia.co.za or visit our website. I've got a little snippet on your bottom right-hand screen now. The website is sygnia.co.za, and then you click on For Me, and then you'll find a lot of information with respect to these accounts, and also sign-up links that will direct you to mail admin@sfs.sygnia.co.za. Anyway, they will have a team of people ready to help you sign up, register, and get the FICA process over with as quickly and painlessly as possible. And that's where the fun starts. This is where you start crafting your portfolio, you start choosing an asset mix, you start to monitor, adjust, and contribute to your portfolio. And this is where things like these monthly webinars, to our research and insight documents that we send out, like signals, And really everything from politics to central banks to global markets are going to become particularly interesting to you because you are now a saver and it affects your retirement annuity. And this is also where we expect you, generally we see you becoming more part of the Sygnia ecosystem at this stage and engaging with us on everything from these monthly webinars to our social media. Ladies and gentlemen, tax-efficient investing makes sense on all levels, the economic level, the societal level, the individual level. The tax-free savings account and retirement annuity are great tools toward tax-efficient investing. They are your tools to use as your birthright as a South African citizen. You have until the end of February to use your yearly allowances, and with Sygnia's super simple website and onboarding process, you know exactly where to start. That's all from my side for now. Thank you for your time. I'll reintroduce Mr. Carl Hewlett now and open the floor to any questions.
Thanks, Marius. That was great. So I'm only 2 questions for me. So let me dive into those and I'll leave the rest for Marius. The first is Kubus, who asks, are any of the Sygnia funds exposed to the Adani group in India? Fortunately not. Yes, the Sygnia Emerging Market 50 Fund does have some exposure to India, but no exposure to any of the Adani shares. So that is good news for any holders of our emerging markets ETF. The second question is from Suleiman, who says, there are so many funds to choose from. What would you recommend for someone who wants to contribute to a TFSA for over 10 years? And I'm going to have just my standard answer on that, which is my favorite fund, which is Skeleton Balance 70. I think that's the default fund for me for anyone who wants to save for over 5 years, let alone over 10 years. It's got 70% exposure to equities. It's got good exposure to global offshore stocks. It's got exposure to our thematic global growth drivers. It's got risk management, and all for an amazing 35 basis points, so 0.35% plus VAT. So that is certainly where I put all my long-term retirement savings. So that would be my answer to that question. But I'm going to hand over now to Marius to go through some of the, and the third question, yes, the slides are available afterwards. It takes some time, but we get the entire presentation up on our YouTube channel. Okay.
Thanks, Carl. Okay, so I'll just go from the top. I see that Mr. JP Lawrence asks if you can move your tax-free ETF to different ETF in your account and see better growth opportunity. The answer there is yes. So as long as the money stays inside the tax-free savings account, you'll still get the benefits of the tax-free savings account. You can move so to answer your question, yes, you can invest in a different ETF as long as it stays in the tax-free savings account. The moment you withdraw it from there, that's when you won't be able to recontribute it. Let's just see. Why is the tax-free savings account assessment based on 30 years? Maximum annual limits contributed annually. Yes, so Vessel's research, if you do mail admin@sfs.sygnia, we can make the research from Vessel available to you. We did publish it, and it's also on our website somewhere. But the idea there is that you'll be reaching the 500,000 Rand lifetime contribution earlier than 30 years. I think you reach it after about 10 to 12. But then that money, the idea is to contribute as soon as possible using those 36,000 Rand contributions per year. And the rest of the time, that's just going to be the benefits of compounding and tax-free compounding on tax-free compounding. That's going to make it grow to that large sum that you saw in the slides. Kurt de Klerk asks, the tax-free savings account comparison shows a total of greater than 9 million over 30 years. Is this true, as the total contribution is 500,000? Yes, that's actually, it's based on some assumptions. I'll make the research available to you after so that you can scrutinize those assumptions yourself. I personally feel they're very realistic. But that is actually the power of long-term tax-free compounding, growing on other long-term tax-free compounding, is that these very humble contributions do actually turn into numbers with many zeros. Anonymous attendee asks, so there are so many funds to choose from. What would you recommend for someone who wants to contribute to a tax-free savings account for 10 years plus? I've sort of alluded to some answers that I personally would find ideal. The ideal is to contribute fast, make use of the 36,000 rands, get them in there as soon as possible, and then sort of watch them grow from there. But if we get to more specific advice, like which funds particularly to choose, and you don't feel comfortable with your own research, you don't feel comfortable that you know exactly what the nuances are between funds and what's the right strategy to target, you can either do your own research, and if you're not comfortable with that, then the best thing to do is to speak to an advisor. An advisor can also look at you as a portfolio, consider your total assets and liabilities and your life situation, and it might just be a safer bet if they do that, and then they can recommend an instrument based on your needs to put into the tax-free savings account wrapper. What's the process to move a tax-free savings account from my bank to Sygnia? Who does the admin? We'll do the admin for you. Just mail admin@sfs.sygnia.co.za. There will be documents that we need from the old institution, but yeah, the right step is just to mail admin. There we have a team that we can also direct it to. See. Marius Louise Sneyman asks, Marius, which 3 Sygnia, unit trusts, or ETFs would you highly recommend for a tax-free savings account for an investor with a long-term horizon and who can stomach risk? Well, it's obviously going to be with the qualifier that this is completely a personal opinion. The best thing to do is to speak to your financial advisor based on your risk appetite and your position in life. I'm a bit of a tech guy, so I always like these thematic style ETFs that we build. I'm a real fan of them. It's what I buy. Whenever I have excess cash, that's what I buy. For example, the fourth industrial, the SIG4IR, fourth industrial revolution ETF. Yeah, that'll be. I'll pretty much just max out my allowance on that fund. But do remember, the right thing is to speak to a financial advisor. You still have a Sygnia Reserve Bank limit on offshore portion in life annuities placed with you. I'm not sure. From Paul Bester, Carl, if you can answer this one, or I think it looks like the right kind of query to direct to admin.
No, the Sygnia platform limit is still 45% for living annuities and endowments.
Another anonymous attendee asks, hello, if are your funds in the retirement annuity protected from creditors only up to age 55? I will walk this answer back if it's not true, but I'm essentially completely sure that it is protected from creditors through and after the age 55. But once again, rather mail admin at SFS and we can get a structured answer ready for you. Linda Kleinskelt asks, what's the tax benefit of investing now in a tax-free savings account? At the end of the tax year, you won't be showing much growth, which will be tax-free. So the idea here is that you get a 36,000 Rand yearly allowance and a 500,000 Rand lifetime allowance. So the idea to target this long-term tax-free compounding effect is going to be to get money into that account as soon as possible. You can't, for example, carry over this year's 36,000 Rand contribution to next year. So you have, the ideal thing would be to use this year's 36,000 Rand contribution now, and then when it gets to March, you'll have another 36,000 Rand contribution. So reach that 500,000 Rand limit by adding up the 36,000 per year as soon as possible, and then you can benefit from long-term compounding over a longer time frame. Are you allowed to have more than one retirement annuity? Yes, you are. Can you use Vanguard USA products? I don't think there's a South African provider that has them ready to invest in. If you have any particular ideas, then maybe mail admin at SFS and we can have a look at that for you. I see quite a technical query from Tom Bell with respect to Alchemy's Regulation 28 compliance facility. I would definitely bring that up with admin to see when we do show you when your allocations are Reg 28 compliant or not. But in terms of the contributions, that's definitely the right thing, is to speak to mail admin, and we'll have that looked at for you. Are there any Sygnia ETFs that are miner heavy, lithium and nickel in particular? This is from Karabo Picheng. I kind of see where you're going with this. You want to capitalize on the industrial revolution. For that, we obviously have the ETF that's more exposed to companies that are going to be part of the industrial revolution, and the Sygnia Sustainable Economies Index. I always argue that this is sort of broadly speaking, you can think of this like a technology fund, but that sort of bets on technology becoming more industrial in the near future and moving away from the world of bits and moving back to the world of atoms. So I'm not sure about lithium and nickel in particular in that fund, but I get where you're going with the question. And if you want to capitalize on sustainable economies, with regard to the lithium and nickel, we do give you exposure to companies that are ahead of the curve in terms of that with SIG SE. Can one move from one TFSA provider to another TFSA provider without losing benefits? Yes, you can. If I have existing RA with Sygnia. So Peter Wentworth asked for Marius, if I have an existing RA with Sygnia and wish to invest a new lump sum into an RA, what are the trade-offs to add to the existing one versus create a new RA? That's quite a complex question. In terms of fees cashing in the third. Wow, Peter, if you mail admin, I will look at your query personally and I'll make sure that we address it in detail. But this is quite a weighty question. Once we start weighing up the total trade-offs and benefits of such a move, I'd rather want you speaking to a professional advisor. And really, I'd rather structure a proper answer to you in terms of that. So please do mail admin, and I'll make sure that we address that. Can you transfer a tax-free investment account from one provider to another? Yes, you can. Once again, mail admin. Can you transfer from one tax-free savings account to another tax-free savings account without affecting the 500,000 Rand withdrawal limit? The answer to that is also yes. So you have a single basket or wrapper, as I've explained it, that's linked to you as a citizen. And if you move that tax-free savings account wrapper to a different provider, your limits are untouched. Will Sygnia notify us, or how can I see when I have hit my 500,000 Rand limit? The capital contributions plus growth shown as one number usually. I don't think we have a red light that's going to go on if you reach your limit. But yes, it's a very important question. It's very important to make sure that you don't contribute more than 36,000 Rand per year and no more than 500,000 Rand per lifetime.
Marius, if I can just add in there, one of the reasons Sygnia can't provide that is that you can have numerous tax-free savings accounts across numerous providers. So we can only tell you what you have with us. We can't tell you what you have with everybody else. And obviously that 36,000 Rand is a global limit per year. So you can have various amounts with various providers and various accounts.
Thanks, Carl. Just looking for more tax questions. Dean Sherman asks to share the last slide on retirement annuity wrappers once again. These slides will be available afterwards and they're going to be on YouTube shortly. Is there an age cap, for example, where it's not financially prudent to invest in an RA and look at alternate financial vehicles? There's no formal age cap. Sort of at first glance, I would think a more tax efficient solution will sort of always be better than a less efficient one. I've seen two questions with regard to foreign dividends in respect of ETFs in a tax-free savings account. I don't know at this moment. Will you please do me the favor of mailing admin so that I can get back to you with a structured answer on that? What retirement annuity fund would you suggest for a young starter? Very encouraging to hear that a young starter is looking at retirement annuity. As the core concept here is that the retirement annuity is just going to be the legal structure and the fund is going to fit inside that. And the answer is, once again, I'll be using the savings to buy a generator, tax-free savings to buy a generator. But yeah, the answer here is going to be, once again, you need somebody to look at you as a portfolio. You need somebody to do an analysis on where you are in your life. And the right person to do that is a financial advisor who can ask you about those particulars and recommend a fund after the analysis.
Great. Is that all the questions, Marius?
I think it's just about all of them, yeah.
Perfect.
Some duplicates, but yeah.
I would just say thank you very much for joining us today and helping out and giving so much interesting information, and for volunteering your time to answer so many questions, which I'm sure are going to get emailed to you. So thank you for that in advance. Thank you everybody for joining. I hope that you found this useful. Certainly, yes, we will make the presentation available on YouTube, so you can get all that information down in one place, and feel free to ask Marius your questions if they weren't answered. Otherwise, we'll see you next month.
Thank you.